Good morning. More pain today, unfortunately. The Bank of Canada has raised rates by half a percentage point. So another surprise meeting. Last meeting, everyone was expecting 75 basis points. They came in lower at zero point 0.5. Leading into this meeting, it was like an 86% chance of a 0.25% hike, and they ended up surprisingly the upside. Came in with half a point. But as of this morning's meeting, market expectations is still for another 0.25% hike. So we're close. We're not quite out of the woods. And, as we've seen throughout this year, that can always change for better or worse. One thing of note, the Bank of Canada did end their release this morning with slightly different language leading into the future. Like the typical, statement they would leave with is, they will be needing to continue to raise rates, basically. Whereas at today's meeting, they changed that slightly to considering whether the policy interest rate needs to rise further. So these little differences do matter. They're leaving the door open to this being it, but they're also leaving the door open for an additional increase, if they see the need. So on the inflation front, inflation continues to come down, but CPI is still quite high. It's at 6.9%. Well off the 2% target. Core is around 5%. But really of note is Canada's 10s 2s yield curve. I've talked about this before, but the yield curve is a really good indication of growth. In a healthy economy, the yield curve will slope upwards, which means the yield on short-term bonds is lower than long-term, which is basically markets projecting growth. When that switches, when that gets inverted, when the yield on the short-term bond is higher than the long-term, that's a really good indication of a recession and poor outlook for growth. Right now, the 10s 2s curve is the most inverted it's been since the early 1990s. So growth is certainly, expectations are certainly not good, and winter is coming. A lot has been made over the last month on central banks. The head of the Australian central bank actually came out last week apologizing to borrowers for taking out mortgages under the expectation that interest rates would stay low into 2024. That's a first. More first in Canada, for the first time ever, our central bank has run a loss. Keep in mind, this falls on the backs of taxpayers. Instead of making roughly $3 billion annually for the federal government, the central bank has run a loss, which is estimated to be around $7 billion over the next 3 years. So, that's around a $10 billion loss that falls on taxpayers' backs. And again, loss for the first time ever. Ever is a long time. They also admitted that they should have raised rates a lot sooner. They said that, but then also defended paying out 18 million in bonuses last year. So more signs of how broken our world has become. Prior to this morning, around 13% of mortgages, all mortgages in Canada, had passed their trigger rate, which means their payments were no longer enough to cover the interest owed for that month. If you're in that boat, if you're in a fixed payment variable, raise your payments if you haven't done so already. Even if you had, do it again. You want to delay that trigger point as much as possible until we know that rates have stopped going up. Around 75% of mortgages in Canada this year were taken out as variable rates. So a lot of people are in a tough place. But in fairness, I mean, really, no one was calling for the hawkishness that we ended up getting, and no one was expecting that. As well, there was the construction of policy with the stress test rate was, I think, inadvertently leading people into taking variable rates to qualify for the purchases. The stress test rate, if you went with a fix for much of this year, you wouldn't qualify for your purchase. Yeah, I mean, I think looking back, this has obviously been the most difficult year many of us can remember. But again, it's like no one was calling for the level of hawkishness that we ended up getting. I mean, I remember when Scotia came out with their expectation of 2% in rate hikes for 2022, and everyone was laughing, saying, good luck in getting there. Looking at my own business, what I certainly got wrong was, we knew inflation was going to be an issue, knew the debt levels were extremely high, and knew that raising rates was going to be problematic. What I totally underestimated was the level of damage that we could see in between when they started raising rates and when they finished. The willingness to inflict economic pain, that's something that, we just hadn't seen from our central bank. In fact, we'd seen the exact opposite of that throughout their tenure. I think for myself, it's even though variable's been the better bet almost 90% of the time in Canada's history, moving forward, it's going to be really important to outline that one time in 10, what could happen, because even though it's unlikely, and even though it's not something that, you will see the majority of the time, a mortgage is obviously a big, expensive financial commitment. And, it's important to kind of understand what that risk looks like. The conflict in the Ukraine certainly didn't help things this year. And looking back throughout the year, it does seem like that was the point where central banks kind of flipped a switch and started using that as the excuse to really kind of raise rates to get themselves out of this mess that they'd put themselves in. But make no mistake, I mean, inflation would have been high, and interest rates would have needed to go up this year, regardless of whether that conflict happened or not. So this is the last meeting of 2022. Thank God. I mean, this is going to be a year that will go down in history, and one that I'm sure we're all going to remember for a long time. Next year is going to be the story of when rates will start to drop, and I would expect some time between mid to late next year before we start to see some relief on that front. But that's it for me. Thanks for watching. Have a very happy holidays, and if you'd like to discuss any of this, please get in touch.